My name is Musa Sheikh. I'm a fellow member of SEMA and a CPA. So this time we have a company, shortly we call that Leo Thera, but you can call it as Leo. That is the company name. So you have to assume that you are working for this company. And so imagine like if you work for a company and you remember the name of the CFO, CEO, and all other main C-level people. Same way, we have to remember the name of our CEO, like Leo CEO, Leo CFO, Leo Chief Information Officer, or HR. So that's the way we need to blink in ourselves. So you don't need to see anywhere. It's your in brain. What is CFO? What is his or her qualification? What is the experience that he or she has? This should be in our mind. This obviously we will read it and you will get all that. So things to learn today is because most of us are from finance background. So I always start the case from the financial section. There are three sections in the exam. One is business, one is finance, and one is internal control and risk. So I generally start with financial because first of all, it's a very important portion. Second thing is that because most of us are from finance, so it's easy for us to start and understand. And once we cover this, so we will be covering 33% of our exam, which is quite a good weightage. So today I'm going to read some pre-scene case study for you. Pre-scene analysis exercises we are going to do, then real-time practice questions related to this section I'm going to discuss with you. And in the last, we have some kind of study notes, which gives you a revision of the concept that the examiner is looking in your head to revise and review, because you have a lot of information you didn't study maybe from a long time. So it's always good to revise the basic principles and concepts. So that's why we put the bookish thing in the end, because these are the ones that is going to develop your analytical skills for the strategic case study. Now, all of you have a PDF case. I just took the extract out of it. So this is how it looks. It is always 26 pages. So 26 pages is going to change your life if you qualify now. So you will become, so these ones only 26 pages you need to read 2 to 3 times and make your notes in terms of the impact. This is the introduction. So what is this country, which is the company, and what is the industry looks like. So because this industry is satellite, so satellite mission stations and launching, this is section number 1. Now, the second section that we have is here. That is the Leo annual report, and all of you in the annual report include your balance sheet, income statement, cash flows, and important information about your share capital and all that stuff. That is the what you call is the financial report, board of directors, board responsibilities, and what principal risk you have. And then we have this financial statements and share price. So this is section 3, and this one is last 2 lines are your section 2. So the exam is section wise. When you open your exam, you will see the section 1, which is the top one. Then you will see section 2, which is the last one, like page 19 to 22. And then you will see section number 3, which is starting from page 12 to 16, or it ends to 19. So that's the way your exam is going to be established. So every time when we will meet, I have to go section wise. Today I'm taking the financial section. Next time we'll take the internal audit section, and then we will go towards the section number 1, which is business analysis, competitive strategies. So that's the way we have, like the examiner has divided the sections like that. So very interesting discussion we are going to start, but I always remind you that your exam is for 3 hours. So 1 hour each section. Section number 1 is business. Section number 2 is finance, which is we are going to discuss today. It is 1 hour, 60 minutes and has 2 questions, and both questions has equal marks. So means 30 minutes for one question and 30 minutes you are going to give to another question. So these two are very important understanding to you, because how you need to manage your time is when you reach to section 2, you will face 2 questions, and the question one of section 2 need 30 minutes. So you have to be very accurate in terms of your time management, because the most challenging in the exam, when I was doing my exam or others I find out, is only the time management, because the day you have a lot of information in your mind and you sometimes struggle to get it on the on the keyboard. You're aligning your thoughts sometimes can take more time than the required. That's why practice always makes things more better. And we have 50% to pass. So all American examinations like CMA, CPA, CIA, they have 75% pass, and CFA has 80% pass. But British qualifications are in this way is more doable, because you are only required to score 80 points, 80 marks out of 150, and it just like approximately like 50% of the exam. So this is just for your revision, that exam is 3 hours, every section 60 minutes, and in section 2 we have 2 questions to go. Now this is the pre-scene which is in your PDF, and if you have read it, it's very nice, but I assume some of you might be busy and you would have not got the time to read it, so that's why I'm going to read it for you. So Leo is a quoted company. What is quoted? Quoted means listed. So means if you are in say England, you are registered with London Stock Exchange and you can buy and sell your shares. That is the concept of quoted company, that provides a range of solutions to the customer's need for small satellites. You make small satellite. There are satellites. Everyone knows satellites, satellite channels, satellite phones. So there are, they are somewhere in the space moving around the orbit. That's a basic concept of a satellite. There can be a small size, big size, and a very big size. So they are good in making small satellites that are generally located in low Earth orbit. These technical things we will learn in section number 1, what is low Earth orbit. And the good thing is that this exam, you don't want to be a scientist or a space astronaut, not at all. What he wants to tell, this is the industry, and we understand a bit about industry, how it operates, what are the cash flow, revenue stream, what are the challenges, what are the risk factors. But anytime you are not required to deeply go and get a knowledge about satellite, how it works, what are the technical parts, that will not be the scope of our exams. So don't worry about it. We have to see that any company we work in, say for example, if you work in hotel industry, it has its own KPIs. If you work in manufacturing, construction, it has its own KPI. Once you will go there, you learn them, and then you will start doing your own reporting based on your accounting standards. So that's the way case study will also work like that. Now the Leo can assist with the design and can support customers in reaching an agreement with providers of launch facilities. So this is a company who is good in design, implementation, and give you all pre and post services, what I understood. Now who you are, he's going to tell you. You are a senior manager in Leo Finance function. Very important. You are not a CFO. You cannot take any decision because you are a senior manager. Senior manager cannot take any decisions. They have to report it to the CFO or the board, and you take you get information and report to someone. So it's not like you are taking decision. Oh, remember, this is why I'm telling you is that in all the exams, we will not say we should do it or we should not do it. We should say, if you do it, these are the advantages and disadvantages. If you don't do it, these are advantages and disadvantages. So board has to decide, this is the information. That's the way you need to understand your basic stuff, okay? Never try to be excited and take a judgment in your exam because you are a strategic case study student. So your work is to think long term ahead and don't take any decisions. Anything you report directly to the board and advise on special projects and strategic matters. Means that you are not required to take any kind of position and decisions. You just have to get information and report it to the board of director. So don't forget this. This is very important, and I'm putting in your mind. And when we will solve the questions, this information should be in your mind. Well, the new head office is located in Wexland. So it's a developed country which has an active and well-regulated stock exchange. Now, this is complementary in a way that all developed countries, they are called as developed countries because they have advanced systems and the values. And second is they have a very regulated stock exchange. These stock exchanges are connected with demand and supply, internal and external environment. So if anything bad is happening outside, suddenly the stock market will crash. If something good is happening in the country, stock market will start going up, right? So how it is relevant is that when Leo will do something good, the stock price will go up. And if they will not do good, stock price will go down. That's the connection between this line and the other line. Wexland currency is also a W dollar because W is a fake country, so it's a fake currency in terms of W dollar. Wexland require IFRS, so International Financial Reporting. The interesting thing is there's no question who will test your knowledge about IFRS, so you don't need to worry at all. It is just like, simple because IFRS has already been tested in operational module and management module. So in strategy, we don't look around technical things. We look the broader things. That's why it's quite a easy, you can say you can feel comfortable that you don't need to revise any kind of IFRS for any reason. And we have a competitor, always strategy cannot be set without knowing who's our competitor and what they are doing. So for example, Pepsi versus Coke, Toyota versus Honda, these are all direct competitors. And so we always analyze the companies with competitors. So that's what the strategy is require, a competitive analysis. So that's why he gave us, or Orba Link is a direct competitor of Leo. It competes for the same contracts and has been in business for slightly longer than your company. And they also operating from the Wexland. So it's like if you are in, say, Jeddah, so there are two companies. If you're in Abu Dhabi, for example, you have two companies, and these two companies are also like a direct competitor, and we'll see what's much common in them and what's so different about them. So that's what is the initial thinking about strategic analysis, in financial terms. So in this side we have Leo, and this side we have Orbanlic Group. These are all their competitors. Now, the years that we have is 2024 and 2025. Basic accounting, financial reporting, IFRS 1 says that financial statement should be made in comparative, means at least 2 years if there is a last year. If it's a new company, obviously it will have one column. But once they go in a second year, they are going to have the second comparative column. So always they are in columns, so you can see here and here. Now, what I'm going to do is first we will see that in 2024, the revenue was 1.683 and it becomes 1.782, means the revenue has increased. If you see the cost is 1155 in this year, 1126, so means the revenue has increased and the cost has decreased, which seems like a nice scenario in a way that the profit and the profit margins will be, because if your cost is going down, it means that if I calculate a profit margin, it will also be more good in 2025 than to 2024. So means company is good, it is progressing slightly even, but it is in a positive direction. And yeah, what we can say, the company is not in loss and they are not in trouble. They are in good way, is a positive way. Now, if you can see finance costs, we can see like there is 100 million increase from 350 to 450. And this 100 increase is a finance, so means that they have taken some liabilities this year, and which will show in your statement of financial position. So that seems that some project has been invested for. They acquire some funding, which they are paying an interest cost on that. So yeah, from just the information, I'm going very random thinking from a perspective, obviously we will go more technical, but this is the way a strategic mind should analyze each and every line and understand what would have happened, which can cause this increase or decrease. You can see because income has increased, because in these tax-based countries, if you have more income, more tax. So you can see because the income, the operating profit has increased, so the tax is also increased. But in any ways, like we can say that the Leo revenue has increased, cost has decreased, GP, the operating profits has also increased. And this year their finance cost has increased, and their tax in that result or as outcome, their taxes are also increased, but they are in good profit for this year. So this is just a commentary, a strategic way with very limited information that so far I don't know what's the revenue segments from where how much is the breakup of revenue, this all that we will move forward and we'll discuss. I'm just going top down view where we have a top, and we are just trying to rationalize that what could be the movements as within the company and within an industry as a competitor. So if you see competitor looks bigger. You can see like in the revenue terms, 2.2 means 2272, and while the Leo is 1.6 or 1683. So you can see that your competitor in financial terms, in terms of revenue, is bigger than you. So you are smaller than your competitor, which can be a challenging situation when you are setting a strategy. This is an important point to keep in mind. But the interesting thing is that this year, the Orba, that is your competitor, also increasing in the revenue. So means that we will talk about industry. The industry is growing. You know that, for example, sometime we have nowadays in, say, UAE, Dubai, we have property boom. So all the developers are making good money because they are selling in good prices. But once the recession comes, all the industry goes in recession. Same way, so we can see that Leo as an industry player, Orba as an industry player is also making money, and the industry is really going good. That's the way I see that from 2272 they become 2566, and all figures are in millions. So You can add like commas and 00 if you want, but generally we don't do it. We just write the same way. Now let's see that the cost 1575, it becomes 1667. So cost in terms of last year and comparatively to this year has increased. And this is how generally it goes actually, because if you increase the sales, the cost associated will also increase. So you will see that cost is also increased with the sales, which is a normal mechanism. But when we see the Leo cost was going down, even the revenue was up. So they are doing good in profit margins. Here we can see the profit margin. Once we will calculate, we will see that. We should keep in our minds always the raw figures, because that will give you a broader, non-analytical assessment about growth or recession or so a point is very important, well noted, and we are going to discuss this shortly. And just before that, we are just going to the figures, because figures are somehow, it is indicating the broader chances of that. For example, now you can see like the finance cost has increased here as well, and for you Leo as well. So means that both in the industry there is something going on positive, which is causing activity to increase, causing revenues to generate more. How much? This is the next question. And obviously when the profits increase, tax also increased, so that's why taxes has increased as well. And if you see the profit of your competitor is 335 while your is 175, so you can see that in terms of revenue, in terms of profits, your competitor is bigger than you. How much bigger? This is the next in percentage. We will see that this is, say, for example, let's assume 70% bigger than in terms of profit to your competitor. Some ratios we don't need to look at, like for example, gross profit sales ratio. That's not strategic, that's operational. So it's a very important point that's why after finishing this lecture, you will be knowing that there are 10 ratios that you need to use. There is no 11th ratio that we can put in our strategic analysis. So I'm going to tell you all these ratios that we need to go as strategic ratio, which is like share price movement, your long-term solvency ratios, gearing. So we will look at the long-term gearing either to the operating gearing. There are a couple of ratios I'm going to shortly discuss with you. It's just like now what we are learning is that who we are, how much is our revenue, and how it is in comparison with our competitors. Just like a starting point. Obviously, after finishing these discussions, we will be top position to know that how much, like for example, that 30% increase in the revenue, 20% increase, like a vertical horizontal analysis, we will do all of them. So next slide, I move it, and it's your statement of changes in equity. Now you can see that, generally when we go for a strategic analysis, equity is a strategic thing. Because owners who are investing in your company, you are a listed company. Remember, you are a shareholder company. People buy shares in the stock exchange, and the money comes to your company. So you are actually acting on behalf of shareholders. That's the way it works. And that's why very, very important strategic analysis will be for dividends, that how much dividend we have given this year, last year, and what overall impact came in your opening and closing equity. Very, very important. So when I'm doing an analysis, I talk about revenue growth, I talk about cost efficiency, I talk about profitability, I talk about finance cost in the income statement. Same way when I reach to changes in equity, I will jump myself to discuss a few lines about dividends. So dividend is the the most important to discuss. I'm not going in much detail as what is dividend, how to calculate it, what will we be doing. So far, I'm just trying to tell that no one gave dividend this year, like, so you can see like Leo also, Leo was now you can see like this is 65. We are talking about 2025. So we don't have been provided 24th dividend. Means what was the dividend figure in last year? I don't know. So a lot of analysis I cannot do, because if the case information is given in a way that 2024 was this dividend, and 2025 this dividend, I can calculate dividend growth model, and we can discuss it. So far we can see that they gave a very small dividend, 65 million only, while your profit for the year was, so your profit was 175. So you can see when we'll calculate, as we just discussed, in percentage, we will see how much exact percentage it is. So same way we will see here that what was the profit for this company and how much dividend they gave. For example, let's assume 40% if they gave. So we will criticize or comment on that if a company gives a very large dividend to the shareholders out of profit, so means that they have kept a very small amount for growth in the company. And if you are giving dividends to shareholder, on the other hand, you are increasing your finance cost, then also it's a strategic issue that why you are creating liability when you have a profit to spend on. So this is the connection. So far we can build up that how much in percentage we give the dividend, is it too much or it is too less, and how much was the competitor was giving dividend. It's same like if Apple gave a lot of dividend, so Google also need to follow, Microsoft has to follow, otherwise people will sell their shares and buy the Apple shares because they are giving more return on investment, which is called dividend. So this is the perspective in terms of equity. Strategic only, dividends, movements, relation with profit, how much profit and how much dividend in terms of percentage has been given to us and our competitor, what he is doing. Great. So moving forward, we have to compare the assets, liability, and equity, which is also a very strategic way. Like, so we saw revenue, we saw dividend, and now we are going to look into the assets. So first, the assets are non-current assets, which useful life is more than 1 year. These are non-current. It can be 50 years if it is a plant, equipment. If it is furniture and fixture, maybe 5 years. Laptop can be 3 years, depending like what's the useful life. So there's no discussion about depreciation here. It just we need to see like the Leo assets has increased in terms of fixed asset or property, plant and equipment means capital assets. And same way, goodwill has not changed. So means that there is no acquisition this year, because goodwill arises when we buy an asset, and then the difference of purchase price become goodwill. So we can see goodwill is constant, and so means that there is no acquisition of business in this year. I will explain it more how I come to know, but this is shortly will be clear about it. Intangible assets are those assets which you cannot touch. They are patents, copyrights. So because maybe they are making any satellites, patents, softwares, patents, so that's why they increase the intangible assets, which are not touchable, but they are very important. And if you just go to the competitors, same way, you can see their goodwill is the same, so no acquisition, and their intangible assets also increase, but there is what you can call is the patents, copyright, software development, anything can be a part of it. And you can see that Same way, your assets are 6855, their assets are 8424. So means in terms of assets, your competitor is also bigger than that. And your assets has increased. Same way, slightly, the assets of Orba also increase. So means the industry is in a growth mode. Everything is going positive. Revenue is increasing. Dividend is also announced. Means that good profit has been achieved. And same way, assets values are also increasing. Now let's talk about the current assets. We generally